All right, welcome to CSI Live. It's October 6th. No, it's November 6th. I think I said last night, days are just very fluid for me. Every day, I don't know, just goes by so fast. It's already November.
Kind of run together.
Kind of run together. Okay, we're talking about, we've got a couple presentations. First, we'll start with Ouster, and then Nick's going to walk us through the 10Q for Axon.
Thought we'd change it up a little bit. We will save Fortinet and App 11 and Qualcomm for some write-ups. So if you were hoping to get a rundown on those via video today, you can ask us about it and we can talk about it. But today we thought we'd do Ouster and Axon and switch it up. Talk about something a little different than what we typically talk about every earnings season. Shannon, we'll do Ouster right away so you can get back to more important stuff.
All right, Ouster fits into primarily the last two bubbles in markets in our semiconductor industry flow, the tech equipment and devices, and they have software that governs their devices as well, but they're a fabless company, primarily fabless company, just a little bit of manufacturing. My little clicker's still not working. Okay. And here's a look at the supply chain for Ouster.
Yeah, Casey mentioned Ouster is mostly fabless these days. Historically, we could consider them an IDM, integrated device manufacturer. They both designed and manufactured their LiDAR devices, but they have sort of outsourced more of that in recent years, especially after the Velodyne merger a couple of years ago. And so their primary contract manufacturers and assemblers are Benchmark Electronics and Fabrinet. So those are the two assemblers, and they source the wafers from a variety of different low-cost wafer fabs. Most of this stuff happens in Southeast Asia. For example, like the Benchmark Electronics Assembly Company, their fab or their assembly plant, I should say, is in Thailand. Another notable thing here, Amazon is probably AWS is where they build their software and where they host their software platform that connects with the actual LiDAR. And as a result of the Velodyne merger a couple of years ago, Amazon holds a substantial amount of warrants in Ouster. So there's probably signifies there's a deeper relationship there on the cloud software and probably also in development of the products for end market uses. So Amazon might actually even be a customer for their robotics division and warehouse automation division. Other customers, there's a couple other notable ones here actually before we move on the right-hand side on the downstream customers. We thought we'd point out one in particular, Serve Robotics. That's one that you all have been talking a lot about over on the Discord server. And that's actually a public relationship between Ouster and Serve. So the LiDAR on those Serve robotic delivery vehicles are powered by Ouster LiDAR. So that's interesting. Maybe you find that interesting, maybe not.
I checked out. All right. So let's take a look at a few metrics that Ouster is using to evaluate their business. These are long-term financial goals for Ouster. They want to achieve, sorry, this is in the way, achieve 30 to 50% annual revenue growth, maintain their gross margins at 35 to 40%, and keep operating expenses at or below Q3 2023 levels. And we're going to take a look at how they're doing on these three metrics, starting with the revenue and the revenue growth rate.
Yeah, this is obviously the top of the top of the income statement. If we were looking at the quarterly report, so obviously that's where we'll start, and it also just so happens to be the best of these metrics. You can see in Q3 2025 another acceleration in revenue growth, up to 41% now year over year. So that's nice to see. Still landing right in the middle of that long-term guidance for 30 to 50% revenue growth, but good to see the uptick in this metric because the last quarter and actually even prior to that, they were below their long-term guidance. So it's encouraging to see that they have been able to accelerate that metric and get it into the mid-range of their long-term guidance and long-term goals. We would expect that this continues, and if not, maybe even accelerate a little bit more to bring the average up within that 30 to 50% target that they had called out.
All right, now let's take a look at their gross margin. So they said they want to keep their gross margin 30 to 40%, and they're actually beating that over these since September 2024. So the last year, they've been beating that goal of their gross margins. Last quarter, 42%, down just a little bit from the June quarter, 45.
Not bad. Not bad for such a small company trying to scale up its operations. So another green check. Let's kind of like check these off mentally. Green check mark. And
yeah, now how about their operating expenses? So the goal was to keep it at or below Q3 levels. So that Q3 is all the way on the left, September 2023. And their total cost operating expense was 38.8 million. And the most recent quarter, 40.9.
The last couple quarters, they had elevated operating expense, not significantly over and above the Q3 2023 level, but not egregiously over and above that either. So maybe this isn't a green check mark, but it's okay. It's passable. The last previous 4 quarters, 5 quarters, they had actually indeed kept it below. So that's good. Perhaps they can average this out again in subsequent quarters because they do have some elevated operating expenses right now, which we need to acknowledge. First, we're going to look at the balance sheet.
Here, I'll go to their free cash flow so we can talk about what their expenses are, and then we'll go to the balance sheet. Go back to the balance sheet.
Okay, all right.
So they're doing some increased R&D work on those next gen sensors, including AI model retraining expenses to improve detection and recognition capabilities. Seems like they need to spend money on this.
Absolutely. And we talked about this during the last update. They are rolling out new hardware and retiring some of the legacy hardware, especially the old Velodyne hardware, and pushing their customers towards these newer, higher performant LiDAR devices. And so obviously in tandem with that, you need to improve the software that goes with it as well. So elevated operating expenses, obviously the free cash flow, negative 20 million, a bit worse than we expected. It was good to see them scaling towards positive free cash flow the last 4 quarters prior to this one. But again, there's a lot going on with Ouster. These metrics can be kind of lumpy from one quarter to the next. Let's maybe not stick a big red X on this metric, maybe just, but not a green check mark either. A yellow question mark.
Okay, let's go back to the balance sheet here. Cash on balance is actually improving 244.5 million. And tell us about the ATM program for their shares.
It's another one of those very appropriately named ATM program, at the market program. When we talk about Axon here in a few minutes, they also have one of these as well, which might be surprising considering how big Axon is. But this is a program where a company has authorized itself the ability to sell new stock onto the open market to raise cash. And so that's why the cash balance went up, even though free cash flow and operating losses were very much a thing in Q3. They were able to more than offset that with the ATM program. But that means shares outstanding, the orange bar, continues to go up sequentially. So this has to be factored into the analysis as well. As Ouster scales up its business and perhaps one day, not too far into the future, they achieve positive free cash flow, you'll have to account for this dilutive effect of the ATM program. So this is definitely another key concern. Obviously, Ouster needs to scale. It needs to get bigger than it is. It needs to land more customers and deepen the engagements with existing customers, but that does come at a cost for shareholders right now. So as we move down that income statement and also look at the cash flow, statements of cash flow, there are some concerns here, but such is life for such a tiny small cap business, which leads us, speaking of small cap business, to some valuation notes. This was from our prior update when we had the Q3 2025 guidance. And we talked about that little cheat that you can use for valuing a business like this that doesn't yet generate a profit. How do you value a company like this? Unfortunately, we're left with things like price to sales ratios, but that's kind of imperfect, right? It only helps if you're comparing the company to peers or other companies with similar operations to it and with a similar growth rate profile. So we dig a little bit deeper here and let's run the scenario where we pretend Ouster can generate a 20% free cash flow margin today and then stick a valuation on it. So we updated this after we have this Q3 update and the Q4 guidance to close out 2025. Casey, what are we looking at now?
So for the revenue, they expect 39.5 to 42.5 million, which will imply a year-over-year growth rate of 32 to 42%. And then we've got the valuation notes there at the bottom. 47x enterprise value to free cash flow based on 20% free cash flow margin baseline. And that's pretending if Ouster was free cash flow positive, which it's not right now, or 36x assuming the same 30% sales growth forecast.
So obviously, Ouster is not free cash flow positive. Why would we use a metric like this, a made up financial metric like this, to gauge the valuation of Ouster? Well, just a refresh from 3, 4, 5 months ago when we talked about this, the expectation is for a company like Ouster and its business model that when it scales up its revenue to a level where it's possible for them to be profitable, a 20% free cash flow margin is sort of the baseline expectation. So let's just pretend that they have the ability to get there. What would they be trading at today? This is kind of what we're looking at. And Pushkar, yes, is there any merit in using enterprise value to EBITDA, earnings before interest, tax, depreciation, and amortization? You can also use EBITDA as well. Yes, that also works. That is another metric that you can use to judge a business that is scaling. The problem, though, is Ouster is, I believe, let me just double check here. I believe Ouster is also not EBITDA positive, so it still doesn't really help you judge the business. Let me just double check really quick. And EBITDA over the last trailing 12 months was negative 88 million on a quarterly basis. Yeah, in this last quarter, it was negative 21 million. So even if you use EBITDA, it still doesn't help you solve for this problem. This is why we kind of have to use our imagination and pretend Ouster has the ability to actually reach this margin and then value it accordingly. This is why we call these types of small bets in our portfolio a prove it stock. You keep the position small, and as the company kind of checks off the list of things they need to accomplish, you can maybe add to the position a little bit over time. But overall, it still needs to remain small, a very small part of your portfolio for the average investor, and then let it organically grow into a larger, more meaningful part of your portfolio organically as the company gets bigger, as the value of the business gets bigger because they're achieving those goals. Does that make sense? Clear as mud? Any other questions? What do you think? What do you think about Ouster?
I'm going to use my imagination and think about the valuation. I like Ouster. It's a small position for us, so I'm comfortable with that at this point. Allison asks, how can we see enterprise value to free cash flow range between 37 to 43 is fair for current Ouster?
For a company growing at roughly, let's say 40% revenue per year, if they were generating positive free cash flow, do you think a roughly 40x free cash flow multiple would be fair for a company growing that fast? Each of you is going to have a different answer to that question. Some of you may say yes. That's a fair valuation for a company growing revenue, growing sales at 40%. Some of you may say no. And especially you may say no because they're not actually generating positive free cash flow yet.
All right. Why don't you move on to Axon?
Okay. If you think of something else on Ouster, let us know. And let me pull up the Axon 10Q. Okay. Can everybody see this 10Q from Axon? Yes. Awesome. Cool. Thanks, Pushkar. All right. So done this a few times now. Let's just run this through the ringer again. This is if we were doing a fresh look. Where we go?
That's me. Sorry.
Okay. Sorry. Let's run this through as if we were taking a fresh look at Axon after earnings. And the goal here is I hope this helps you parse through an earnings report and whittle down to the actual facts you need to know and remove some of the more fluff stuff that takes place during quarterly earnings season. Okay, so this is the actual 10Q, which you can access these. Most companies issue these simultaneously with or shortly after the actual earnings press release. And in fact, the press release is in here as well on these 10Qs. But what we want to do is start with the way we do it is we like to start with the income statement, which happens to be on page 3 for Axon, and just like to run this through the growth rate. So what we do know about Axon is, yes, it is a large company approaching 3 billion a year in sales. And their goal is to keep that growth rate basically above 30%. So it's a high growth business. They see themselves as having a lot of growth runway for the market they serve, primarily in the United States, serving law enforcement and other public safety companies that help, like maybe like retail stores with security or event security. Like if you go to a football match, American football game, or something like that, concerts. So they're meeting that goal. They grew sales just shy of 31% year over year. But that does come at a cost because they do have elevated expenses. And so if you've been following Axon for a while, you know that this is not really a new thing, but on a GAAP basis, GAAP being the profit metrics you would find on the actual income statement, for quite some time now, they've been just barely GAAP profitable. And it's actually gotten worse in 2025. It's actually now at a GAAP loss for the trailing 9 months, just shy of 12 million in losses from operations. Also, something to take a look at here when we look at the balance sheet, where is this interest expense coming from? Notice this right here, over the last 9 months, first 9 months of 2025, why are they suddenly having to pay $65 million in interest expense? They must have taken out some debt because they had basically no interest expense last year. Okay. And then the last thing that we look at on the actual income statement is the total share count. And you can find that here. Let's look at the diluted share count. You can see that it's up roughly 400 million shares. Sorry, thousand, roughly 300,000 shares quarter over quarter, and a pretty sizable increase in the share count compared to this time last year and the average diluted share count. So another thing that we need to look at when we go to the cash flow statement, which is what we do next after we do the income statement, let's kind of reconcile what we're seeing here on the income statement with actual cash flows, which is a non-GAAP metric. Okay. So how do you reconcile this? So you start with GAAP metric here at the top, and then here's the adjustments for it below. Stock-based compensation is always, for a lot of high growth companies, is always going to be one of the biggest line items that gets backed out to calculate free cash flow. Pretty big increase, $200 million increase in employee stock-based compensation this year. That's notable. Obviously, they are investing in something that is costing them a lot of new employee and talent headcount. And with this size of an increase in stock-based compensation, you can almost bet that it's probably something software related, not hardware related, which is Axon's historic business. Okay, so that's the biggest line item here to reconcile the GAAP metric with free cash flow. Let's just quickly skip down here. If you have questions on the other line items, let us know. But after you back out all of the non-cash expenses, we're left with net cash provided by or used in operating activities, -$6 million, compared to $158 million through the first 9 months of 2024. So the company is obviously in a period of elevated investment to keep their growth rate higher. One last item to get to free cash flow: purchase of property and equipment, aka capital expenditures or CapEx, also slightly higher, $74 million. But overall, a fairly asset-light company, but a $21 million year-over-year increase in CapEx. So obviously, what must be happening here with their R&D, obviously they're investing a little bit in hardware, but it must be software initiatives that is accounting for the R&D because of this big stock-based comp line item. Before we look at that, what exactly they're investing in, let's look at the balance sheet, which was at the very top of the 10Q. Really quick check here on cash and investments. You can see the big increase in cash and short-term investments compared to the same time last year. Well over $1 billion net increase in cash and investments. Where did that come from? So the first place to check is, did they increase their debt? Because obviously this isn't increasing because cash flow was positive. Cash flows were actually negative in the last 9 months. They must have taken out debt. That's the most obvious answer. And here we go. Long-term notes payable. They had none. at the end of September 2024. Now they have 1.7 billion in debt. All right. Management took out debt to fund growth of the business. What exactly are they going to be doing with that? Okay. We can actually now go to the shareholder letter and get all the fluffy explanation about what's actually happening with these R&D investments. Okay, so here's the Q3 shareholder letter. Axon 911. So if you know Axon, you know most of their business is hardware. They sell the taser devices, they sell the body cameras, security cameras, but they've been investing in software, and their big new initiative is they want to completely upgrade and transform the United States 911 emergency call infrastructure. And they're offering their own thing, Axon 911 call handling and AI enabled communications. Okay, but they're spending a lot of money. It seems like a high amount, especially why would they need to take out 1.7 billion in debt? Well, they made a couple of acquisitions, announced a couple of recent acquisitions. And here in the top left of this graphic, Prepared and Carbine, two acquisitions that they just recently announced. These are the big software investments taking place. So they've been doing some in-house organic R&D, and now they saw a need to purchase these to accelerate that R&D development of the 911 system, and integrating that with all of their other hardware, so that there's things like real-time tracking of law enforcement or whoever's wearing the body camera or the sensors. They're merging this with this company. I actually don't know how to pronounce this. I don't know how this company is pronounced, but this was an acquisition last year. And then they also made an acquisition of a drone company last year as well, so that they're going to integrate all this different hardware and make it observable through this software system. So pretty cool stuff. Obviously, it's costing shareholders right now profit now. Obviously, Axon hopes that the profit will be much higher later on if these investments pay off. But if you're wondering what happened to Axon stock, these investments have been taking place actually for the last couple of quarters. We had a write-up about it at the beginning of this year. And a couple of you in the community that own Axon stock have been keeping us up to date on all of this. It's a period of elevated R&D, of elevated investment. The valuation for Axon was very high, and so the stock price has been adjusted down to basically de-risk it. You have to account for some of these R&D investments not paying off, or maybe not paying off as well as hoped for. And so, yeah, you need to bring that valuation down to account for that probability, that future possible outcome of Axon not being as profitable as it has been in the past with its core hardware system, with all of this new stuff. So the last step after we've done this like analysis of the quarter, now let's do an update on the valuation, but I'm going to let you do that. That's for you to do. We'll let you take a look. You can weigh in with what you're seeing, but we thought this was a notable company report to call out and take a look at after the stock fell 20%. I'm not sure where it ended at the end of trading, but I know it was significant. It actually ended up not being down that much. It ended up falling 9%. Okay. At open, it was down 20%.
bad.
Obviously, the market reassessed and thought, you know what, this is a great buy the dip opportunity. At any rate, it is still down off of its all-time high by a pretty significant amount, let's say 10% plus, perhaps 20% even from their all-time high. The company has a strong track record of driving positive returns on investment. Pretty cool tightly integrated hardware and software business. I know it's kind of a controversial business, so maybe that doesn't really jive with your worldview, and that's fine. We just thought we'd draw this to everybody's attention. Any questions? I put everybody to sleep. It's late. It's really late in the US, and you've probably fallen asleep at your screen.
Allison asks regarding Ouster, where did it go? How long maybe will it take for us to see positive free cash flow for Ouster, or how to speculate it reasonably?
Good question, Allison. So you remember, if you look at the free cash flow chart, the last 4 quarters, they were actually really, really close to break even on free cash flow. Obviously, they had a quarter with elevated expenses. They probably spent money with Amazon AWS, we would imagine, to retrain their AI. But if you remove those expenses, it would seem that Ouster, excluding one-time expenses like they had in Q3, is very, very close to break even on a free cash flow basis. They're approaching 200 million, and no, what are they approaching in annualized sales now? Sorry. Yeah, sorry. They're approaching 160 to 200 million in annualized sales. Perhaps they'll reach 200 million in annualized sales. Is that a big enough scale for a company to be free cash flow positive? I would say yes. Our expectation is within the next couple of years, they achieve free cash flow positive territory. That would be our expectation. If they don't, something might be going wrong. But if you have a couple hundred million in sales, even as a fast scaling business, you should be able to generate positive free cash flow.
All right, thanks for those questions, Allison. Pushkar asks, have you had a chance to look at the quarterly report of Figma? They reported great year-over-year growth and even increased the annual guidance.
Very briefly, Pushkar, it's still one that we're monitoring very closely. We like seeing the enterprise value of Figma back at 20 billion. And I think did we say that publicly? I'm pretty sure we said publicly that that's kind of a level where we'd be interested again in making a purchase. They didn't quite grow revenue at 40%. It was just under 40%, but okay. Price to sales ratio upwards of 20x on a 1 year forward basis. It's a premium price, but if the company can continue to grow north of 30% year over year, it might not be a completely unreasonable price tag to take a very small starter position for us personally. And then we have like some extra incentive to monitor it and continue watching what's going on. We didn't look at the report in depth, but just the high level numbers, kind of like what I showed you on the 10Q, just kind of looking at the revenue growth and expenses, cash flow generation. It looked like it was a solid Q3. It was above where they guided on like the high level metrics. Hope that helps.
All right, I think that's a wrap.
Uh,
Oh, sorry, Shannon, I didn't. Shannon says regarding Ouster, we never hear about the other verticals, smart infrastructure, robotics and drones and industrial. Mostly hear about automotives, which is at least interesting about the company, in my opinion.
Yeah, agreed, Shannon. Ouster is interesting because I think they, especially in their earnings calls, they do actually spend a lot of time on these other end markets. And I think that's a nice reprieve from the self-driving car steady drumbeat that we get from the media. Obviously, Serve Robotics, you could say is a type of autonomous vehicle application, but it serves a very specific niche with last mile delivery versus passenger vehicle autonomy, which is I mean I don't know how else to say it. I don't think there's an easy An easy way to put it for everybody that thinks we're all going to be like riding around in self-driving cars imminently. It's not going to happen imminently for passenger vehicles. Even Texas is like throwing up a little bit of resistance to some of like the Tesla robotaxi, and that's kind of known to be a pretty low barrier regulated state. So it's these other markets, as you point out, Shannon, are, I think, we believe, the more important ones for a lot of this industrial automation or physical AI, physical robotics, as some call it, and Ouster participates in those. Yeah, cool stuff. There's also the forklift company. I don't know if you noticed that on the little supply chain chart. That's another public customer that Ouster has, out of Japan, Komatsu. So that's kind of cool. I think they may have another. I think Komatsu the European division of Komatsu does electric mining vehicles, and I think that was probably the customer Ouster referenced in its Q3 earnings call. Um, yeah, and John Deere. Nice. You got a story there, Shannon?
Did it have LiDAR?
Did you ride in the John Deere tractor as it drove itself, or did you drive the John Deere tractor? Organic farmer. Cool.
Pretty cool. That was like one of my favorite things, was riding in the bucket of a tractor when my grandpa drove it around. So it'd be kind of fun if you had like a LiDAR electric tractor driving you around in the bucket. Not dangerous.
Don't try that at home,
Don't
folks.
try that at home.
Nice.
All
Okay.
right. Thanks everybody for joining us today. Hope you have a great rest of your week, great weekend, and we'll be back for more. And hope you are too.
Yeah, we
Thanks.
will. Keep an eye out for the write-ups on AppLovin, Fortinet. Qualcomm might get pushed out to next week. We recently just did the update on Qualcomm with the data center inference announcement, so we may delay that one a little bit, but yeah, Fortinet and AppLovin for sure.
All right. Take care, everybody. See y'all soon.